One of the questions I get asked, do your clients constantly look at cutting their expenses or do they just track them? And I'm going, well, it depends. Sometimes they do want to cut their expenses. Now, I believe that the best way to look at your financial statements is to analyze your income, your expense, your assets, and liabilities. And in fact, I'm going to go ahead and share my screen here, and I'm going to show you exactly what I'm talking about. If you look at your financial statements, and here's your income statement. So you have income and expense, and then we have your balance sheet, and it's your assets and your liabilities. The question I get asked is, well, how do I know if my income's good? Some of you are going, wait a minute, all income's good. False, not all income is good, because there's another financial statement that we have over here, which we call the statement of cash flow. Cash flow is everything. So when I look at income, I want to know, is it producing cash flow? You go, well, how can I have income that doesn't produce cash flow? Well, if somebody owes you money, you do the work for them and they owe you for that work, that's not valuable to you until you collect the money. One of the biggest problems with owning gold is storing that gold. You pay month after month just to keep it locked away and your stack never grows. But with monetary metals, the model is flipped. Instead of you paying fees, they actually pay you in gold to store your gold with them. That means your ounces go up every month. Now, how does that work? They lease your gold to qualified vetted businesses like jewelers, refiners, mints that need it for inventory to operate. In return, you earn a yield, typically 2 to 4% a year, paid directly in gold. Now, how is that possible? Well, everybody knows that if you're a retailer, wholesaler, etc., you have to maintain a certain amount of inventory on hand at all times. And rather than buying that inventory, they're leasing the inventory from you. So they have the gold there in their inventory for 12 months. And after 12 months, you can get it back or you can renew your lease. That's how it works. So for many investors, this simple shift, turning the cost of storage into a yield on their storage, is the difference between watching wealth erode and watching it compound. Monetary Metals has already completed over 75 deals across 5 continents with thousands of ounces paid out to clients, and so far, 0 losses. So if you own gold, ask yourself, why let it drain you when it could be working for you? Go to monetary-metals.com/CPA today and see how your ounces could start growing again. That's monetary-metals.com/CPA and let them know that I sent you. So one of the first things we have to do is we have to look at, is the income good income? And it's only good income if it produces cash flow. Then we have to look at the expenses. The expenses we're looking at, do they increase income? So that's the purpose of an expense. And what I like to do is I like to see my clients do a plus, a 0, or a minus on every single line item on their income statement. Is that expense maximizing income? Is it doing nothing? It's just like break even, or is it losing money? And if it's losing money, of course, what I want to do is on the losers, I want to get rid of those. On the break even, I actually want them to be a plus. If I can't make it a plus, I want to get rid of it. So that's the very first thing I'm looking at in a financial statement after the income is, does the expense actually produce cash flow? Do my marketing expenses produce cash flow? Do my employees produce cash flow? Does my inventory produce cash flow? These are simple examples of, do they produce cash flow? Next one is, do my assets, I do the same thing with my assets. Now, the purpose of an asset is to either increase income or decrease in expense. So you can get a robot to decrease your expenses as an example. So you can increase income or decrease expenses, because either way, if you do that, you should be increasing your cash flow. So on my assets, I do the same thing I did on my expenses. Expenses and assets, they're on the same side of the ledger because they're the same thing. An asset is just a long-term expense. That's all it is. So we're still looking at it exactly the same way. If I have an asset that's not producing, I want to sell the asset because it's not producing cash flow. It's actually costing me money. If I have one that is just break even or not doing that well, I want to make sure that increases my cash flow, or I want to get rid of it. What if you could lower your tax bill and stack Bitcoin at the same time? Well, by mining Bitcoin with Blockware, you can. New tax guidelines from the Big Beautiful Bill allow American miners to write off 100% of the cost of their mining hardware in a single year. That's right, 100% write-off. Now, if you have $100,000 in W-2 or business income, you could purchase $100,000 of miners and potentially offset it entirely. And you have to dot your I's and cross your T's. So make sure when you are doing this that you plan with your CPA tax strategist. Blockware's mining as a service enables you to start mining Bitcoin right now without lifting a finger. Blockware handles everything from securing the miners to sourcing low-cost power to configuring the mining pool. They do it all. You get to stack Bitcoin at a discount every single day while also saving big come tax season. We always want to make money first, and then we want to make sure we're saving taxes on that money that we make. None of this is tax advice. So go speak to the team at Blockware to learn more by going to mining.blockwaresolutions.com/Tom and meet with your tax advisor. All right, now here's the real trick. What about my liabilities? What's the purpose of a liability? Well, the purpose of a liability is to buy an asset. So when I'm analyzing my liabilities, I'm not actually analyzing my liabilities. I'm actually analyzing the assets. And then I'm looking at the cost of the liability compared to the profit of the asset. So the cost of the liability compared to the profit of the asset. And if this is not positive, this should be more than one. The cost is less than the profit, so that would mean it would be more than one. This should be greater than one. If it's not, I have to go, well, wait a minute, I might need to pay off the liability, I might need to refinance the liability, or there's something else I might need to do in order to get the asset to perform better so that it outperforms the liability. These are the types of things that successful entrepreneurs do that most people don't. They don't even consider them. So we want to make sure that we're considering, should I be cutting my expenses or should I really just be making sure they're deductible? Because one way to increase the value of an expense is to get a deduction for it. Now the government pays for 40% of it. So if I have an expense that, let's say it's break even, but now I get a deduction for it, well, now it could be a plus just because I got a deduction for it. So I do want to make sure I'm classifying my expenses properly so that I make sure I deduct all of my expenses. Now, there are surprisingly, anything can be deductible. You know, wait a minute. No, that's not true. I mean, like bribes aren't deductible, entertainment's not deductible, cruises aren't deductible, but money is fungible. Okay, I'm going to show you what that means. So fungible means that money is money. It doesn't matter which money it is. So if I take an example here and go, let's go back to my financial statement. And I have income and expense and asset and liability. And I go, okay, I want to deduct the cost of my season tickets. I've got football season tickets and I want to deduct the cost. And let's say it's $100,000. So I have an expense of $100,000. Well, season tickets would normally be non-deductible. So how do I make that deductible? Again, the question is, how do I make it deductible? Not, is it deductible? Well, what if I had that $100,000 and rather than buy the season tickets with $100,000, I took that $100,000 because I had to have $100,000 of income, right? In order to get the money to buy those season tickets. So rather than put it down here, what if instead I put it here and I combined it with a liability, and I'm going to combine it with a liability of $400,000. Then I've got $100,000 of cash, $400,000 of liability, and now I have a $500,000 asset. Okay, well, what good does that do me? Well, let's start by this asset. Let's say this is rental real estate. Now what do I get? Well, now I get bonus depreciation. So I get bonus depreciation. And let's say I'm going to get bonus depreciation of $150,000. Could be less than that, could be more than that. And I'm in a 40% tax bracket. That means that that is worth $60,000 to me in real money. So that means that $60,000, I no longer need $100,000, do I, to buy those season tickets? I only need $40,000 because the government's paying $60,000 of the expense. I'm only paying $40,000. Well, let's say this $500,000 piece of real estate produces cash flow of $4,000 a month. $4,000 per month. Well, $4,000 per month, last I checked, was $48,000. That means that the first year, what do I get? I actually have $8,000 left over. So I actually made money because I bought an asset instead of using the money to buy the season tickets. Why? Because I get a big deduction for that asset. Well, here's the cool thing. I'm going to get that $48,000 every year, right? That's not a one-time benefit. That's like going to keep going. What do I do second year? Well, second year I would have another $100,000. So I'm going to buy another $500,000 property. I'm going to take another $400,000 loan and use that $100,000. I'm going to buy a $500,000 property. I'm going to get another $60,000. I can do this every year. What have I effectively done? Effectively, all I've done simply is turned a non-deductible expense into a deductible asset. Remember, I said in a previous video that an asset and expense, they're the same thing. An expense is just a shorter period asset. An asset just lasts longer. It produces income over a longer period of time. So it's important to understand the similarities between an expense and an asset. An expense should produce income once or over a short period of time, whereas an asset produces income over and over again. Well, aren't I better off having an asset pay for my expenses? Because then I get both the tax deduction for the asset and I actually get that expense paid every year. And you can start adding this up because remember, if I've got $48,000 first year and I've got $48,000 the second year, well, the second year, I still only have that $40,000. Now I have $56,000 left over. I mean, you can see how the rich become richer. And this is a type of a deduction that people miss all the time. I will tell you, this is one of the greatest lessons I ever learned from Robert Kiyosaki. Robert explained to me years ago, he said, never buy doodad. He calls them doodads. Never buy a doodad or liability unless you buy an asset to pay for it. That's what we're doing here. The cool thing is, if we do it right, the government's also helping to pay for it. And this is how we call this tax effective, not tax efficient, not like the financial planners do, tax effective investing. Because we are reducing our taxes through our investments. Again, something the wealthy do, the poor and the middle class never even think of. So remember that we are going to track our expenses. We're going to track how they're doing from a tax standpoint. This is how we leverage our expenses. We get the tax benefit for them. The people who get audited, they're not tracking. They're not documenting. They're not taking care of this. Instead, what they're trying to do is they're trying to deduct the entertainment. Why not just take the bonus depreciation? IRS is never going to complain about that. Now the IRS is happy, you're happy, everybody's happy because you're paying less tax doing what the government wants you to do. Now, the people who get audited, 9 out of 10 times, they didn't track this next part that I'm going to explain in the next video. So here's the real difference. Wealthy clients don't just know these habits, they live these habits daily, consistently, automatically. And if you want to do the same thing, I made it easy for you. You want to keep more cash in the next 30 days without changing your business or working harder? Grab my free guide. It walks you through exactly what to track, how to structure things, and what to stop doing today. But it's only available for a limited time. After that, it's gone. So be quick. Click the link below and download it for free.